at Moneylife. Anybody who's a subscriber here or reads Moneylife? Not too many. Just a line. At Moneylife, we believe that financial products are needlessly made complex and complicated by three sets of people. The financial services companies themselves who produce, the distributors or the agents who sell, and of course the regulator who is supposed to regulate and make it all very simple and easy and customer friendly for us. They don't do their jobs, which is why we have sessions like this. I wish we didn't have sessions like this, which would really mean that people are able to choose a financial product fairly easily and confidently are able to use it just as they are able to use consumer products or durables and so on. But unfortunately, that's not so. Which is why we have these stories. They are common to virtually everybody, with a little bit of variation here and there. You start out by being an earner, so you earn some money, and mainly salary, or it could be business income. You spend, you withdraw from ATM, etc. The moment you do that, things start getting complicated. You're probably paying a huge EMI. A few days ago, we got a mail from somebody in Hyderabad. The combined family income between husband and wife about 65,000. They have some surplus now, but she's writing to me saying that after I move to a new house and start paying my EMI, which is about 25,000 rupees, I will have no surplus left at all. If you are in one of these situations, things are quite bad, because then you would have no money to invest for future, for various large expenses like children's education, like retirement, or any sort of eventuality which may happen. Even those who don't have large EMIs or large outgoes and have money, their money is usually lying in savings bank account. And one fine day they wake up and either they push it into FD or they fall for a tax saving option, which sometime around March an agent comes and sells it to them. So they go and buy an insurance policy, mainly that of LIC. A terrible product to buy, but they realize that only after 5 years, 6 years, or 7 years later, or maybe 3 years later. Or it could even be a ULIP, which people are buying less now, but a lot of them bought in 2003 to 2007 and have nothing to show for in terms of the performance. So a small number of people, maybe not about 5% of the people, actually a systematic investment plan in equity mutual fund. So this is roughly the story. A small number of people, maybe larger than those who buy equity mutual funds, are also victims of what is called mis-selling. So they're outright lied to or cheated, or they have no recourse to either the regulator or anybody else. The cheating could be done by the bank, by an agent, by an individual, by a company, doesn't matter, because the entire incentive structure in the financial services industry is such that the producer wants people to sell, the intermediary is to sell at a commission, and the whole job of the intermediary is to sell, not to look after your interest. Even if you have escaped all of these problems, most likely your money is lying in a product that all Indians love to invest in. About 13 lakh crores in the entire banking system is in savings account and bank fixed deposits. What's wrong with this? Something is seriously wrong with this option, and that is we choose always the easy option. We buy an insurance product in March. We leave our money in fixed deposits. We choose what behavioral finance theorists, it's a new branch of study, you can call it neuroeconomics or you can call it behavioral economics, they all call it the availability bias. We are biased to what is available. We don't want to step out of that and try and seek. It's very easy to make your story completely different, and I see a lot of people here who are young. You have about 30, 35, 40, 50 years ahead of you in terms of both savings as well as post-retirement period. Make your story completely different with the knowledge that people have gained over analyzing these products both in the US and as well as in India. Solution to all this is amazingly simple. You should save enough. Unfortunately, I didn't have a solution for the lady who wrote to us from Hyderabad, because you don't have savings. If you bought a property on which there is 25,000 EMI and you have nothing left at the end of the day, there's nothing that I can do. Either you have to raise your income, reduce your expenses, or you should not have taken a house with that kind of EMI. I don't know what the option is. In fact, the builders have created a situation where it is gone out of our hands. There's nothing a salaried individual living in an urban area can do about such high EMIs. But if you are fortunate enough to have surpluses, try to see that that is your first point of entry into creating whatever you need to create. Somebody else asked me that how should a professional invest, for instance. A professional, an individual, somebody with dependence, without dependence, for all of them the starting point is this. You just have to have a lot, or whatever relative to your position, a lot of money at the end of the month. Whatever your position is, if it's nothing, it's bad enough. There's a rule of thumb I use, which is 25% of your income. So if you're earning 100,000 rupees every month, you should be having 25,000 surplus. Surplus means clear surplus. After EMI, after your LIC policy premium, after everything else, this is your starting point. Investing this is going to create everything else that you would want. Move your money into 2 to 3 right products regularly. Buy term insurance if you have dependence. Insurance, it's a surprise to a lot of people when we say there are a small number of people who do not need life insurance. Why? Because they have no dependence. A small number. But we generally tend to think, I need a life insurance. You don't need it. If you have no dependence, you don't need it. As simple as that. But if you have dependence, you need it, certainly, and you should buy a term plan, preferably an online term plan. For some strange reason, for a 25-year-old person, non-smoker, I'm talking about a male, a 25-year-old non-smoker, he can buy an online term plan for, let's say, 5,000 rupees. Same 25-year-old non-smoker buys an offline term plan, identical conditions. That 5,000 rupees will become 11,000 rupees. That's how the market is today. Nobody knows why it is so. We actually tried to investigate a lot, and we actually did a cover story 3 years ago called Online Term Plans. Those of you who are subscribers can access the archives and go and see. All insurance companies told us that the online term plans are cheaper because they feel that those who access online term plans are of a certain kind, certain profile. They are careful about health, they're smarter, etc., etc. I don't know if any of this is true, but as long as there is such a huge difference between an online and offline term plan, there's absolutely no reason to buy an offline term plan. Within that, some are good, some are, a little bit of work is needed, not in half an hour, 45 minutes that I've been given. It's not possible to go through all of this, but you just need to look at cheaper online term plans and those who have a reasonably good claims payment ratio, which is all freely available from the website of IRDA. Now, this was about regular savers. The second group, maybe you're 5, maybe you're 45. You already have saved up quite a bit of money in a variety of investment products. You need to move money from your heavy dependence on your bank fixed deposits to investing in higher return products. I'll explain why and how. In general, these are the 5 rules to follow, and my presentation will follow more or less these 5 rules. All you need is clear goals. What are you investing for? For which goal? All right? Don't get too technical about it. It's rough. And there are ready tools available to separate one goal from the other. A few simple financial products to meet all these goals. Apply the principle of compounding. The best results of investing come over a long period of time to a patient saver. I'm using the word saver, I didn't use the word investor. So even if you do nothing other than, I know a person who's doing this, even if you do nothing, then save as much as possible and just put it in recurring deposit. It's taxable, it's not high return. The simple act of disciplined investing through recurring deposit is going to lead you to a lot of money in the end. It's not the best, but the discipline can any day beat too much of knowledge and too much of finding out, or if nothing else, the default mode that I described earlier. That is far better. Understand simple concept of risk, return, inflation, and asset mix. There's a lot of complicated theory behind all of this. Just absolutely no need to know. We at Moneylife believe that we'll create knowledge so that people read and they know. All right, that's great. So it's only for those who want to go deep into the subject, who want to be what is called a do-it-yourself investor. For them, Moneylife is a great tool. There's no doubt about that. But even for somebody who does not need to know all of that, can they really invest smartly? Yes, they can. And I'll show you just understanding basic concepts of this is going to help. And stay away from all other sales pitches, because in the marketplace, nobody is your friend. The regulator is not your friend. To repeat, the financial services companies are not your friend, and none of the agents and distributors are your friend. This is something that you should just burn in your mind. Matching goals with products. You need a flat, you need a home loan. Fortunately, from 2003 onwards, we've had a fantastic tax regime in this country. You get up to 2.5 lakh rupees deduction in tax, 1.5 lakh I think for interest, 1 lakh for principal, or it could be the opposite, I'm never sure. But 2.5 lakh rupees out of your income can be tax deductible for buying an apartment, which is an incredible tax benefit that the government of India has given, which has been responsible for the incredible growth in the housing industry that you see, and which has saved a lot of people from high inflation that subsequently this country has inflicted upon them. Marriage, 2 years away, maybe 5 years, 7 years, 8 years away. You have to first, if you're in the tax saving bracket, I should have said this before. If you're in the tax saving bracket, your first job is to reduce your tax to the bare minimum legally, which means that you just have to take advantage of all the ATC benefits that the government of India gives, which is your equity linked savings product, your PPF, and all of that. Fairly straightforward, simple. Anybody will tell you what these are. Freely available in so many websites. What are the ATC products? Don't buy insurance under ATC. All right. So once you've reduced your tax, if you're in 30% tax bracket or in 20% tax bracket, you need to have that as a component. Fixed income products as a component. I'll explain this, which fixed income products, and some amount of equity, which at this stage I would say equity mutual funds as your product, as your component. So in a certain mix, this is of course fixed by the government, you're going to get 1.5 lakh rupees, and then fixed equity. Between these two, what should be the mix? I'll explain a little later. Children's education, best for the long term, maybe 10 years, 15 years down the line. There's no product as good as equity and stocks and equity mutual funds. I can see a look of disbelief every single time. The moment I mention stocks and equity mutual funds, Indians don't invest in any of these products. And thereby they miss out on incredible and probably the only opportunity to create wealth long term which can beat inflation. This is all recorded, tested, discussed, analyzed, sealed. Health expenses, health insurance. A lot of people now feel that health insurance premium is so random, so crazily expensive. Claim denials are so frequent that it's good to use some of these products to create a health corpus for yourself rather than pay health insurance. We haven't done a study. I don't think that's easy to do, but health insurance is one of the options. There are multiple options within that. Family floater is a good idea. Super top up is a good idea. Just read our blogs. We have mentioned. I've already mentioned term policies. retirement, long term again, exactly like children's education, stocks and equity mutual funds. So each of these goals have specific products or specific set of products to help you. I mentioned that somebody just doing nothing other than saving crazily, cutting down on expenses and doing a recurring deposit would also have a lot of money in the end. Let me illustrate this. Everybody knows about it, but unless you see the impact of this in a simplest form, or no doubt, but unless somebody sees this, they will not realize. Suppose somebody is investing only 1,000 rupees per month or 12,000 per annum. She earns an average on this 10% a year. So this is how the investment and the returns would flow. In the first year, 12,000 is invested. 10% of that 1,000 say is 1,200 rupees. At the end of the year, the two together, 13,200. This is added another 12,000, so it becomes 25,200. Another 10% on that, that is 2,500, and 27,720 in year 2. If this continues for 30 years, one would have invested 3,60,000, 12,000 a year for 30 years, but the wealth that person would have is 21 lakhs. This is the benefit of compounding. To illustrate in the chart, it will be the green part is the principal, 12,000 each year. 12, 24, 36 adds up to 3,60,000. See how dramatically the impact is towards the end. Once the figure starts growing, the 10% on that each year is such a remarkable figure. A highly oversimplified chart, because who's giving you 10% every year, right? But if you see on an average basis, a simple mix of products can easily return. For instance, today if you are in a 30% tax bracket, you can buy a tax-free bond of Government of India companies, National Highway Authority of India. All right, you can buy a tax-free bond which will give you an yield of 8.5%, tax-free. That's post-tax. If you put 50% of your money, somebody says 30, somebody says 70, you want a simple solution to all of this. Suppose you have 1 lakh, you put 50% in this tax-free bond. You're going to get 8.5%. It's a 25-year bond. I've taken 30 years, let's take 25 years. So 25 years, you're going to get that return. At the end of it, you're going to get back your principal. Now, for the rest, another 50%, if you put in equity mutual fund, which in the worst 10-year period, any worst 10-year period, equity mutual would have given you 12%. This is tax-free, so it's long-term capital gain. So 50% on 8.5 is 4.25. 50% or 12% is 6. 6 and 4.5, 10.25. Tax-free. Tax-free bond, second is long-term tax-free. So it's possible through a very, very simple way to build this kind of wealth. You just need to tune out anything else anybody is saying once you're on this particular track. Your regular savings go a little deeper into the mix. Your regular savings, fixed income for stability. Some amount of money has to be in fixed income because your principal has to be protected, and quite a lot of principal has to be protected, because anything else you do other than fixed income will go up and down. It could be a bond fund, could be a gold ETF, could be equity mutual funds. They're all what is called market linked instruments. The moment it's market linked, they'll go up and down. Human minds hate anything that's go up and down. We love certainty. We love predictability. We don't want things to go down. Go up, that's great. But we certainly can't deal with anything that is unpredictable. This is again part of the learning from behavioral economics. So if you're in 20% or 30% tax bracket, these are your options. Choose a mix. A little more sophisticated work can go into deciding whether it's 20, 20, 10, or 20, 20, 30 or so on. But I'll just give you some rough idea. Bond funds, I mentioned sometimes. Why? Because, to go a little technical, if interest rates go down, bond funds go up. So you would want to buy bond funds at a time when interest rates are high, which is now currently. Interest rates are high. Interest rates are going to go down. If they go down, your bond fund will go up. If you want to avoid that, please go ahead and do it, because you're going to lose only a marginal few percentage points here and there if you don't choose bond fund and choose a tax-free bond. This is certain. Tax-free bond, 8.5%, nobody can take it away from you. Government companies, principal is guaranteed, check comes quarterly, and a little bit in bank FD. Why I said bank FD? Why not full entire money in 8.5% tax-free? Bank FDs are taxable, all right? Because you earn that 8.75%, you apply a 30% tax, you're going to get 6 point something. The reason is that tax-free bonds are also traded in the market. They are also market linked. And unfortunately, Indian debt market is not liquid enough. Desperately need to break that FD. You may not be able to sell if you have 10 lakhs, 15 lakhs kind of, or even more money in tax-free bonds. You may have to wait for a few days. So certain amount of money needs to be in. So even after paying penalty, at least you get from the bank. And if you're in 0 to 10% tax bracket, if you have no tax, if your earnings are too low, then obviously even simpler, because whatever interest you get from the bank FD is fully tax-free for you. You don't pay tax. Now, part B, which nobody invests in. Equity mutual funds to beat inflation. So that was part A, fixed income, equity mutual. Let me tell you a very interesting story. All this, how to create a mix, was invented by a gentleman called Harry Markowitz. He won a Nobel Prize. He did this in 59 or so. And then he subsequently won a Nobel Prize for creating what is called technically called an efficient frontier. Meaning at what risk, at what mix the portfolio is most efficient. Is it 60-30? Is it 60-40? 80-20? At risk and return the best. So that is called an efficient. So somebody asked him, Harry, how did you invest? He said, I worked all the numbers and eventually I decided 50-50 would do for me. Right? So the guy who invented all the variations in which you could invest eventually did what you and I would do. Close your eyes, 50-50, and that does it. It's really powerful story of how simple, if tools are right, a simple process can get you great results as well. Little bit of more detail on mix. Fixed income, if you're really young, 25 to 30 or 32, not married, I'm very aggressive. You should put 80% in equity mutual fund. And you will never regret that you came to this. Fixed income, 20 to 35%. Alright, so it depends on your age group and your ability to take risk. We have a slightly different version of ability to take risk. We say you can't decide what is risk. The risk that you take is decided by the products that you choose, the marketplace that is outside. Okay. So if you say, I have a higher risk appetite, it's really a bunch of nonsense, because if the market is down 30% after you bought, you would tell, why the hell did I get into this? So nobody has any risk appetite. It varies. The market goes up, our risk appetite goes up. Collapses, we are very. Risk is objective, it's not subjective. Which means that if somebody who's younger, who's invested regularly in equity mutual funds, also suffers a 9-month 60% decline, as has happened in January 2008 to October 2008, when Sensex went down from 25,000 to like possibly an intraday low of 7,500 or so. It's frightening. And now the Sensex is back at 26,000, 25,000 plus. Now, even if he had invested regularly through this entire period, he would have come out far better than any product available to him at that time or subsequently. The reason is that he can invest for the longer period. So if you're young, you have to look at 5 years at least or more, which gets to our first point. What is your age group? If you're young, you say, I have 30 more years of earnings left, and it's okay for 3 years or 4 years and done too well, it still will do well. I'll show you in a subsequent chart how our ideas of what is not working well is very, very selective, because our memories are very selective. We are very negative people when it comes to finances. When we want, we'll focus our mind on something that hasn't worked. See, stocks have gone down. But we never focus our mind on, say, see, the stocks have gone up. But I'll explain that later. And whether you have dependence or not. Yes, if you have dependence, then surely your ability to take risk certainly goes down, because you're not doing it only for yourself. You're doing for somebody else who's dependent on your income. And that definitely reduces your ability. Then you'll probably do 35%. And for bonds, 65% for equity mutual funds. The most common question, the two most common questions that we face from those who are interested is it a good time to buy it? Of course. And of course, which funds and which stocks? Now, we say it's not a relevant question, because it is very unlikely that you're just going to pull out because I said so, you're going to pull out your money and just plonk it all in the marketplace. Most people in the first group that I talked about have regular income, regular expenses, and obviously would do regular savings and regular investment. So if that is the flow of money that you get, what are you going to do with this one information, whether it's the right time to buy or not? Look at this chart. Sensex fell so very sharply on that particular year, and went up and down and then up again. Now, if somebody was investing regularly all through this period, the Sensex, this is of course March 14th, okay? So December 2007 to March 14th, Sensex is up only 10%. You will see Economic Times writing an article saying those who avoided equity mutual funds are laughing now because Sensex hasn't gone up at all, it's just up 10%. They won't write when it's up 30%, okay? Or they write it's up 30%, invest now. So during this period, Sensex is up only 10.35%. Anybody who's investing regularly in this manner, their portfolio 36.68%. The reason is very, very simple. Only a small amount of money was invested at the beginning of the period when the index fell, and larger part of the money was invested subsequently. Now, your question would be, why did you choose this period? Why not choose some other period? We have tested this. We have chosen every 5-year period possible from 1992 onwards. Every 5-year period on a basis or even on a monthly basis. We have not come across a single 10-year period, for instance, where people would have lost any money at all, and almost 87% of the time on any 5-year period of your choice, you would have by buying equity funds, particularly not asking is it a good time to buy or not. That takes us to investment horizon. How long, which product? Unfortunately, as I mentioned, equity and equity mutual funds are volatile products. They are market-linked products. They go up and down, sometimes completely unreasonably, without any reason at all. If you go and ask people, why did the market fall 250 points today, you will get 20 different answers. Nobody really knows. In the short term, that kind of a market movement is irrelevant. However, up to 3 years, unless one is very fortunate in able to buy at the low without knowing about it, any up to 3 years, it has to be protected, value should not fluctuate, and therefore equity funds are not good. 3 to 5, you start mixing risky products like mutual funds and safe products like fixed income that I talked about. 5 years plus, certainly risky products like mutual funds do very, very well. This has been tested by us, as I said. Among the 4 key concepts that you have to understand: risk, return, asset mix, so on, one is in. I'll just give you an example. If you are earning low returns, if all your money is in bank FD and you're in 30% tax bracket, you get only 5.7 to 6% in hand, and you're in a high inflation situation. By high inflation, I define 10% plus. India has been permanently in an inflation situation. No matter what the RBI or the government of India say, there's only a small period there's been only a small period in 2001, 2, 3 when inflation was low, because everything was down. It was almost like a recession hit situation where everybody's earnings was low. And if there is growth, or even if no growth, as has happened in the last 2 years, inflation in India has been high. I thought that it will come down after the new government, but I'm even more convinced that we are going to face a less high inflation situation for a long, long time, and it's going to change, because this budget does not do anything to reduce the size of the government and therefore demand for the government's money and therefore reduce inflation. This is the reason why inflation is high, because the government is just too big. It's a monster which needs more and more money. Now, official inflation can be 8%. For us who live in urban areas, inflation is not 8%. Nobody calculates that. I shouldn't say nobody calculates. There is now CPI urban and rural, which is consumer price inflation, urban and rural. All government statistics have to be taken with a pinch of salt. I certainly don't agree with the CPI urban, because I don't think inflation is 8.3%. Inflation for us is done double digits, because all our expenses are the kind that don't go into that index with the adequate weights, like school fees, for instance, or a car cleaner's salary. I'm just giving some smaller examples, but the kind of expenses that we have in urban areas are not counted in the same weight in the CPI urban. So assume that your inflation for you is 10%. So you will have a situation, you put a lot of money in your bank deposits, low returns, high inflation, which actually means capital loss. Let me explain. When you start, inflation is such, you will end up with 11 lakhs value. So what could buy you 1 crore would buy you worth only 11 lakhs. Alright? And if the inflation is 10%, it will worth only 4 lakhs. So people who are investing for the long term are not bothered about how they are investing in the long term and putting a lot of bank FDs, not saving enough, not investing enough in the right kind of products to give them higher rate of return, which beats inflation, are going to really land up in a lot of difficulty, especially if they're doing it all by themselves, for themselves. And so retirement is a complicated area, extremely complicated area, especially since people have different situations. Some people will live with their kids, or they'll be supported. So all of those issues are there. I quite recognize that. And if those things are put into the equation, maybe you will not be that bad off, worse off. But if you are trying to do it all for yourself and you're planning all for yourself, a retirement corpus, if you don't pay attention to where your money is invested, this is a real threat. We get a lot of mails from people who are in late 30s and 40s, even 50s. They have made mistakes in the past. They read Moneylife, they want to correct their mistakes. So we say first categorize. If you're into one of those categories, so we say first put all your investment into these brackets. How much is your fixed income? Where have you invested? Mostly, a lot of money has gone into insurance, stocks and equity funds, very little, gold, and others, maybe monthly income plan, capital guaranteed funds, and so on and so forth, and any other products that you have. So roughly, these are the places where most, apart from provident fund, public provident fund and employee provident fund, and so on, it's forced savings. We say allocate your investments into fixed, insurance, if it's possible, bring it down to zero. May not be possible because you are part of a plan. If you can't withdraw, if you withdraw, there's a huge amount of penalty and you get nothing in your return. Put your money in stocks and mutual funds in this particular fashion. Gold as you need. I have a 4-5 slides on gold, which is little technical, but the takeaway is very clear. Don't invest in gold for investment. Invest in gold for yourself. I'll explain. The mix again depends on your age and whether you have dependents or not. Now, to repeat what I said, in one place, the kind of returns that we can expect from different financial products. Indians love to ask when they buy a new car, Kitna deti hai? So that's the same concept over here. Sensex up by 14% post-tax in 20. All right. Gold 8.7% over 20 years before tax. You have to pay 20% tax after indexation. Maybe tax will be low, but if there's zero tax, it's still only 8.75%, 8.7%. ULIPs will fetch you 6 to 8% post-tax. Bank FDs 8.75 before, after 30% tax 6.2% only. Traditional insurance plans 4 to 7, maybe even lower. We did a cover story where we said 2%. There's an HDFC product which will give you only 2%. Good. Real estate, nobody knows. To help you categorize, since we are talking about products that beat inflation, real estate may beat inflation, as Mr. Ali said, that if you buy it at the right time. Some ULIPs may be able to do it. Blue chip stocks, certainly. Equity mutual funds, most certainly. These products don't beat inflation, which is life insurance products, fixed income, gold, small savings, so on. Now, gold as an investment. Gold has recently seen, I think sometime from 2001 onwards, gold prices started moving up in a huge way in the international markets and also in the Indian markets, because Indian markets are all determined by the US markets. We tend to put gold in the same basket as every other product. Fixed income, gold, equity, and so on and so forth. Gold is fundamentally different from every single kind of investment product. Look at this. If you buy real estate, some income, fetches rent. You put your money in fixed income, fetches interest. You buy stocks, you get dividend, bonus, buyback. There are a variety of ways you can get money. Gold, you buy gold, anybody gives you anything? No, there's nobody to give you anything. Which in financial terms means that gold yields nothing. There's no yield, there's no income attached to it. And most people who study returns and markets and so on find it impossible to value gold, because there are well-established ways of valuing financial products which is a multiple of the yield. If a real estate, if a flat yields so much, you can multiply that and you can say this should be the value. Anything that yields nothing and is bought and sold is a speculative product, pure and simple. You're only buying that you can get another person to offer you at a higher price. That's the only objective that you're buying it for. In the same category is art. Same category, yields nothing. You can look at it for a whole day, it won't give you 1 rupee in return. Alright? So these are investments for certain people with a certain objective, not for the average saver. Now, to go a little deeper, how is the price of gold then determined? If it's not based on yield, if it's not a multiple, like a stock is a multiple of earnings, for instance, what determines the price of gold? We've done a lot of work on this. And I'm really proud that nobody else in India has done as much of work into whether gold is correct as an investment or not as we have done. I've done 2 cover stories and 2 special sessions on gold. The sessions are all in YouTube. Gold is determined by the 6 factors I found out. One is direction of the dollar. So if the dollar becomes stronger, rupee becomes weaker, our gold prices go up. How does it happen? Take the case of gold. So gold is, suppose dollar is 50 rupees to a dollar. It's at 50 rupees. If it becomes 60, you will, without you doing anything, the same price of gold you will multiply by 60. India doesn't produce gold. Everything that we buy is imported. So you will import at 60 rupees instead of 50. Rupee has weakened, becomes 60, you will import at a higher rate, that's a rate. So you investments have done nothing. The country has gone a little weaker, the rupee has gone a little, so your price of gold has gone up. One. Inflation and interest rate in the US. It's called negative or a real yield. If inflation is high and the US treasury bills rates are lower, then people invest in gold because they're losing money in buying treasury bills. The example that I gave you, 10% inflation, you put money in 6% bank FD, you're losing money. The rich people don't want this. So from Switzerland to Dubai, if US treasury bills are yielding 3% and inflation is 4%, they say, oh my God, let's get out of treasury bills, let's buy gold. Weakness of Indian rupee, I've explained already. Demand and supply of gold in India and China, little bit, not too much. Buying and selling by central banks, hugely. If central banks come to buy gold, gold prices shoot up. Alright? UK started selling gold all through to the late 1980s, through the 90s, right down to 2001. They sold the last bit of gold at the bottom of the gold market. And then the gold prices started moving up. If central banks buy, prices will go up without you knowing or doing anything. Alright? And finally, inflow of money into ETFs. They're called financial gold. So gold exchange traded funds which take money from you, invest in gold, drive up the prices of gold. Gold ETF is huge in the international market. An average Indian saver doesn't know any of these 6 factors. Even fund managers, experts don't know this factor. So gold ETF fund manager who has asked you to invest in his gold ETF does not know what is going to happen to any of these 6 factors internationally. He's clueless. He's invited you to his gold so that he can make money off your money. Because the structure of the mutual fund is that they get a percentage from the assets that they gather. Yes.
Potential exposure like in the case of commodities exchange which recently happened? Are they actually backed by gold ETFs?
You see, there is a scope for fraud everywhere. I don't know what's happening in the international markets. Indian mutual funds are highly regulated. They haven't had the chance to have fun for a very long time. So whether it's equity, whether it's these products or whatever, they more or less stick to the rule book. So my personal knowledge of the fund management and what they do and so on. So I don't think there's scope of much fraud here unless it really becomes a bubble, it really becomes big, and then all these ideas start coming, cutting corners and trying to do something or the other. So Indian mutual funds are very scared kind of animal, not able to grow much, so they'll stick to the rule book as of now. To summarize, gold prices mainly based on movement of dollar and rupees, go up and down on inflation, interest rates, dollar and rupee. We don't know much about these, but stock price on profits. There's nothing on earth which can hold down the price of a stock if the company is doing well. It's a simple equation. The profits are higher and higher and higher, stock price will be higher, and not in the linear fashion, not in the smooth fashion. They will go up, the direction will be up. Real estate may go depending on scarcity and the development, scope for development. Bank FDs are guaranteed. Nobody can take your money away. If you have not invested in cooperative banks, if you have invested in scheduled banks, your money is 100% safe. On paper, you get a 1 lakh deposit guarantee. In real life, RBI will not allow any bank in India to go down. Not cooperative banks. They don't regulate cooperative banks closely. Any other type of bank, even a bank like Global Trust Bank, which went bankrupt in 2001, overnight on Friday evening, they've called up Oriental Bank of Commerce and forced them to a merger. So depositors' money was safe. So it's guaranteed. None of these characteristics apply to gold. They go up and down, they don't give you any income, and nobody guarantees them. And gold has gone up only 8.7% in 6 years. However, this is not designed to tell you don't buy gold. Buying gold is completely different from buying gold as an investment. Again, once again, if you see a good piece of art, you want to buy it, it's your decision. Don't buy it as an investment to get another guy to sell it to you. You like that piece of art, you want to watch it for the whole day, please go ahead and do it. There is a value, there's a huge value beyond money for that particular thing. So, it's an important aspect. As I said, you need to gift, you pass it on and so on. If you need gold and cannot bear the thought of investing for the long term in equity funds, which will do better than your gold, buy physical gold in regular amounts. This is the solution. Avoid any other form of gold, whether it's gold ETF, e-gold or gold funds. These are, to repeat what I said, financial gold. They're market linked, they're not in your hand, and could well be that volatile market movements may force you to sell as well, which happens with equities, for instance. In fact, somebody very interestingly points out, what if our flat was listed in the stock market and you could see them going up and down in ticker? Something like that will happen to your gold. When they're down 10% one day, you will call your broker and say, get me out of my gold ETF, God knows why I bought it. If you have physical gold with you in ornament form in the bank, you're not tempted to do any of that because you need that. Real estate. To completely agree with what Mr. Ali said, no reliable database of price changes. Even the government doesn't have this data. National Housing Bank has started collecting this data for the last three years ago. They're relying on real estate brokers. They put out an index called Residex quarterly. The figures are all wrong. One fine day you will see that Bangalore real estate prices have gone down by 13%. Nobody has seen that 13%. Nobody has taken advantage of that. But that's the quality of data. Exactly what he said is my view. For every cousin of yours who bought in Pune in 2003 and is sitting on 5 times wealth, there are so many other stories of being cheated by builders, bought and sold at the wrong time, bought at such high prices there is no appreciation for years together. Huge costs involved in this. People do not normally calculate the cost, they calculate only the gross returns. Brokerage, registration, stamp duty, maintenance. You really want to keep the flat in the ship-shape condition for you to sell and get a market value. All of these costs are there. They eat up a lot of your appreciation. Worst of all, at Moneylife, we have a simple principle. A lot of things we have simplified our life. One is this, I'm sure Suchita mentioned it in the first session, if there's no regulator, don't touch it. This is a property that you would buy for yourself, which is all very fine. You want to buy a second property, you're likely to get caught in any of these things. And the largest number of complaints we have is from insurance and from those who have given money to a builder and not getting the money back, not getting the flat back. The consumer courts have started getting very active about this. Recently, Supreme Court has told Supertech either give money back at 14% interest or give an alternative. This is the first time that kind of a judgment has come. But there's no regulator. It's a long fight. And Supertech, that building was very expensive coming up in Gurgaon. There are a lot of wealthy people that could fight up to the Supreme Court. Who has the time and the money and the opportunity to fight like that? So no regulator, no scope for grievance redress. All right. So I say real estate is for professionals. Passion for it. I have a friend who gets up in the morning, drives his SUV, goes and looks at flats under construction or land somewhere 50 kilometers from Bombay. Well, he can do it, I guess. And those with lucky breaks. The guy next door has to go abroad, selling your flat 20% below cost, buy it, okay, and then sell it. Insurance as investment, one of the worst things in the world. And all insurance companies, there are 7, I think, or 19 of them, their whole business is this. It's your investment company, effectively. Your money is put into stocks and bonds in different proportion. If you bought an endowment plan, a policy kind of thing, not put stocks. You put it only in bonds. So what you're effectively doing is, instead of you putting your money in a bank FD or tax-free bond or a bond fund, you're giving it to LIC to do exactly that. What sense does it make? You will, and who will pay for, if you're an Aviva policy holder, who's going to pay for Sachin? Because you're going to pay for it. They're not going to pay out of the. So all the costs. So the commission, the cost, everything is there in the middle. Minus all that your return from same product. So you got 8% from a bond, they'll get 8% minus 2%, 6%. That's how the return is so low. All their overheads, all their costs, everything is loaded somewhere in the middle. And you don't see that because they're opaque. They don't tell you where they invest. ULIPs slightly better because they invest a little bit in the stocks, but same story. If you were to do that mix yourself, 80, 20, 70, 30 mix, 30% in bonds, 70% in equity mutual funds, you will beat all the ULIP fund managers who are being paid ₹1 crore plus in salary. Finally, 5-point everything, borrowed from Chetan Bhagat's title. Save at least 25% of your income. Put it where? Fixed income, bank, FD, tax-free bonds, equity mutual funds. In what mix? 20, 35, 80, 65, depending on where you go. Why? This is the only way to beat inflation and create long-term wealth. Any other product, avoid. So simple. Really made your life really, really simple, I hope. One final thing. In all this, women have the edge. What a surprise. Everybody thought it's the men who know all about investing. A lot of research into behavioral investor behavior by scientists have proved that men are not better investors than women. The reason for this is very, very simple. In investing, you have to first think of risk. How much you could lose, right? And this is so even in case of trading. For even trade, women traders are better than men. Why? Because they don't go for this additional risk. They first think of the loss. Women are more cautious. They should be naturally better investors, especially if they follow the Moneylife principle.